Good day, fellow investors. It's already December, so we have to update our value investing risk and reward quadrant. The idea here on the quadrant is that we have reward on the x-axis, so from low with the red to high reward, and then we combine it with risk, low risk green, high risk red, and the target is to find companies the most close to low risk, high reward, if that is even possible in the financial environment, and avoid the things that are highly risky. And of course, we can start from here, then go to the other buys that might be interesting to you and your portfolio. Buy number one, sorry, this is my life, so I live off this, not YouTube, my research platform. You can check that, what I do, you can see whether a value investing perspective there would be value adding to your long-term wealth compounding adventure. I think there is one good buy there that's really something, a punch card buy, so you might want to check the platform now in September. But speaking of that, there is what I do on my research platform, and true value opportunities come very rarely. So it's always a challenge to combine YouTube, publicly speaking about things, saying things, and really specific portfolio research. I prefer to have that under a premium, great customers, great clients, great comment section, so I really think it's working for me. But if we go to check what's on YouTube, what we have discussed over time, how we have positioned that in the value investing quadrant, let's immediately start with Aker BP. With Aker, 2% of my model portfolio, Norwegian oil play. Will also touch immediately on Petrobras and Occidental, which are the three petroleum plays in the area. So the company merged, had some issues, of course, all oil companies had, but for now has been stable. The key there is a 10% yield, but with one caveat, and that is Norwegian taxes, withholding taxes. So you have to see how much of that 10% actually trickle down to your portfolio. Petroleo Brasileiro, Petrobras, 10% dividend yield. Occidental, 2% yield there. They want to lower debt first, and then perhaps with oil prices at 80, pay higher dividends and doing buybacks. So let's start with Aker, Norwegian sea player, so they drill oil there. I would like to go fishing halibuts. Maybe they do both here, but okay, they own great fields, a lot of oil, and the key there is that they have the lowest capex, the lowest costs. They also project growth going forward, about 20% in production, and they will create value, cash flows, irrelevant practically of the oil price. They should make 5 billion at low prices, 10 billion at 40 barrels, 65, they should make 15 billion over time. Dividend, debt service, repayment, things like that, and also investments in growth. If oil goes higher, that's a P ratio of 1 on the market cap. Now, the situation with oil, the key factor there is, of course, oil prices. And there are various scenarios when it comes to oil prices. For now, we have projections, or like things are going, of stable demand for oil prices, but I'll dig into oil, likely prepare something deeper next week, so I'll look at more players, what's going on, to get a better picture, but that takes a lot of research. However, then investigate, if we look at Aker, the key there is taxes. Their profit is 1.6 billion for the quarter, and you can see here huge tax payments, and that is what is left of the profit. So 71% tax profit payments. That's Norway, but the costs are so low. And the fact is that even if oil goes lower, the operating profit goes lower, but so do the tax payments, so that the net profit just lowers a little bit. It is hard for them to start losing money because of their big profit margins. If you count out taxes. 2.5 billion profit before taxes is 1.5 billion. So at oil at, well, where are we, 60, they have a 40 profit margin without taxes, but oil should be at 20 and then they would just not pay taxes. That's something very important to keep in mind. And they said as long as oil is above 45, they keep the dividend. And we can see here, of course, a little bit of weakness in the oil sector. We have been around 7-ish 2024 and we are now closer to below 6-ish now in 2025, and too much oil, and people are expecting that it will go even lower. If it goes even lower, on the expectation of oversupply, that's how it goes in the market. Everyone is going for growth. We'll discuss more that next week, thus lower prices. So that is something that we might expect, and then we have to look at the sensitivity of a player towards oil prices. But if oil prices go to 50, you can expect all oil stocks to go down. So when it comes to predicting oil prices, okay, now everybody's predicting a glut. Lower prices, lower stock prices, but it's very hard to really know. Some shocks, geopolitical this, that, left, right, OPEC cuts, things like that, and you can quickly see oil at 80. That completely changes the pictures from an investing perspective. And that can, for example, especially be seen with Occidental, that at 50 doesn't make cash flows, but at 80 does a lot of cash flows. So when it comes to exposure, you have to see, okay, do I want oil in my portfolio? We are now on a relative cheapness, not absolute cheapness, but relatively cheap. I can start with 2%, follow, learn. When you own something, you know it better. And then when the time comes and you see, okay, this is now really good, then you increase it to 6, 8, perhaps even higher percentages of your portfolio. Speaking of Occidental, you can see here the cash flow sensitivities, 265 million per $1 price change. If we look at prices are down $10. Somewhere around from 5 billion in free cash flows, we go to 2 billion all else equal next 12 months. And you can already see that reflected in the stock price. That's down, what is that, 30-40%. On top of everything, they will be repaying debt, but they have sold OxyChem to Buffett. However, that was profitable, 800 million, plus this was a big investment, thus likely 800 million in cash flows are already gone. That's what Buffett does. He buys 10% yields, 8% yields with huge upside in the upcycle, and he bought that into the down cycle. So the higher a company has production costs for oil, the higher will be the volatility of the stock price. If oil goes to 100, Occidental is a double. And last time we discussed Petroleo, Petrobras. You can check here in this video. I'll put the link in the description below to all the stocks that we mentioned for the deeper analysis. So next on the quadrant we have flour foods. We have just recently discussed it 5 days ago. A very interesting situation, possibly a dividend cut that might not be priced in, but I'm keeping it here, still learning about it. I don't own it, we'll see how it goes. Very interesting video if you want to check it. But on flour foods, a comment, CNH Industrial. Let's see what's going on with our CNH Industrial, David Einhorn's food industrial pick. Of course, the stock is down significantly as the traction there, the expected recovery in Latin America on demand from agricultural equipment hasn't happened. The stock is down, not profitable likely at the moment, but you have to understand that is a cycle. We are here now on margins. When the cycle is big, when farmers start buying equipment again, this is what happens, and then you can see higher profits, cash flows, dividends, buybacks, and that's usually what happens with this stock. Somewhere in the future you get to a 15, 20, 50%, 100% up, plus some dividends. That's a cyclical play, and that's why it's here, likely 10% going forward, but that doesn't mean it might not go down another 30%. Which would then increase the upside over time. This is cyclical agriculture player. Value looks like now, so see how it fits your portfolio. Next one we have Fiserv, we just discussed it, and not much new has happened since we discussed it. You can check the video here. The thing now is it will all depend on next earnings. If they go back to growth, the stock will go up. If they have more issues that they have to deal with, the stock will go down. It's as simple as that. Can we predict it? Well, Wall Street analysts didn't manage to predict this, and they have been following the company for decades. Now, whether the stock will go here or here, very hard to predict, but from a valuation perspective, long term, you should do okay. Also, in a diversified portfolio, but check next earnings. Now, here in the middle we have Domino's Pizza. We have looked at all the Domino's companies, and Domino's Pizza Group looked very interesting. High dividend yield, but the stock keeps on going down, and after the earnings we have had more bad news. CEO departure after just 2 years. That's never good, but they will not now go into the second brand acquisition. That was bad 3 months ago, so we'll see, everything looks bad. Once the stock starts going down, everything looks bad. However, stable sales, EBITDA still there, but we can value it on EBITDA perhaps a little bit. So let's say this is worth 10 times EBITDA, that's 1.3 billion minus the debt. 1 billion market cap is 700 billion, so we are there for a private takeout. However, I might have found the big issue here with Domino's, and that is gunpowder chicken and masala paneer pizzas with complimentary wings products. The Indian feast pizza, this reminds me of Vanderpool putting ananas on his pizza, ketchup, things like that. Perhaps Domino's is not more a pizza, but who knows what company. Of course, I'm joking a little bit, but the stock is significantly down. Any kind of growth, the dividend is there. So if you like the dividend and it looks like they can keep it, it gets interesting. Of course, the acquisition that they have been planning, but perhaps with lower stock prices they can get a lower acquisition in the market, but private equity usually snatches things up. So interesting business to follow and to look, and we'll learn more about it over time. Now, Greenbrick Partners, I have discussed a little bit over the last videos. I have discussed this into the Wagons Pabrai fund. He also owns home builders in the States. And I will have to remove Greenbrick because I'm simply not a specialist on US home builders, and I don't plan to become one. So it looks cheap, they are reinvesting, buying the land, the value of the land, things like that. All looks good, all the home builders look like that, but I have a sense, and I don't want to waste my time on researching that sense, but I don't know, so I'm going to just remove it. I don't think I can add more value there. Now, speaking of removals, I have also moved Amsterdam Commodities out. That is because I have now Aker that I own on the research platform, and Amsterdam is too niche, too small perhaps to discuss it online. We'll discuss in the next few days Barry's also closure of the fund because he simply doesn't want to deal with these things. The investors on my research platform know what we are doing. Just on YouTube, it doesn't really makes sense. Who wants to investigate more? We have discussed it a few times in the past, but I'm not going to cover it anymore here on YouTube. We'll transfer to oil. Next year we'll transfer to something else. I'm sorry, but it is how it is. Now, next, Pabrai Wagons. We have just discussed it in a video, you can check it. We discussed it yesterday. I don't know what is the yield there, but on a value proposition it should be positive from Pabrai. HPQ, everything looks good there. You can see there is volatility, but it's a slow and steady compounder. So if you're looking at that, everything looks okay, good dividend yield. The last earnings have just come out recently. Good cash flows, free cash flows. earnings per share, revenue growing for the year, everything looks good, 3 billion free cash flow compared to the market cap, nothing wrong there. There is some debt, but they are managing that. The cash flow returns, okay, looks stable, a little bit declining, but not that terrible. However, the outlook also 2.8 billion on cash flows compared to the market cap. That's a double-digit free cash flow yield, but the stock is down. Why? Because it's always about the sentiment. The market doesn't know where will this go. The key issues from the conference call were increased prices in chips, in memory, so that is now a negative a little bit on the company, but that is the market, that's ups and downs constantly. You have to see whether you want to own this company. And they are going to work with suppliers to see whether they can find things differently. But still, AI maybe will help them because people need to buy stronger and more powerful computers. So, very interesting, cost-saving targets, cash flows. I still think it looks like a 10%. I still look at what I don't know, but it is very interesting. ASML here, 8, 9, 10%, still going higher, great business, but as we discussed already, it was much better. A few months ago the risk was low and the return was high. Now the risk is higher and the return is lower. It's just simple mathematics there. Plus, we'll see in a downturn, in a semi-cycle downturn, how it goes. Nomad Foods, not great earnings, but we have discussed that last month. Then we have the Dow Chemical still paying a good dividend. The stock seems to have stopped bleeding, and that is also something you might want to look into it. There is some debt, but we don't know when the chemical sector will revert. However, now it's time to dig deeper, and that's also something that we might do when we look also after the oil sector. On the other companies, Amazon, Google, great businesses, Warrior we discussed with Pabrai, Verizon always there, Schwab, Nike, nothing new, S&P 500, we will discuss it tomorrow. I will give you 1.9% shareholder yield going forward, questionable growth, so very, very ugly. Stocks to buy, my opinion, check my research platform, there is something that I really like. Aker, I have started building a position, we'll see how far it goes, depends on the ups and downs over the next year of the market. And then this you have to investigate, understand the cycle here, understand how it goes here, the risk and reward, and then see whether it might add value to your portfolio. So there are 1, 2, 3, 4, 5, 6 buys there, 5, 6 buys that you might want to consider for your portfolio. Now, what I also want to discuss is this emptiness, and this emptiness is because we are living in such a world. I have listened to Michael Burry's interview. He is looking ahead and he says that there will be a few bad years for the stock market. If that happens, that emptiness might get filled. So this is simply the environment we are living in. You can find pillars of value if you go with this likely 10% returns over time, what fits you better, what you want to learn better, and then you have a good portfolio of those things. I don't think you will do badly. You can reinvest the dividends, you can compound over time, and then, let's say, do okay, whatever goes forward. I'm more hedged of a type of guy, but that's difficult to discuss here. I'm looking forward to your comments, and I'm going to do a lot of research ahead. I like my portfolios, don't have much to do rather than research, allocate just a little bit here and there on the positions, and that's about it until something big changes in the market. Thanks for watching, I'll see you in the next video.